NVIDIA, not the only earnings to watch this week. We're getting reports from really big ones. Okay, Okta, Kohl's, Abercrombie, HP, CrowdStrike, you got Dollar General. So a big panoply here of tech like Dell. And then, of course, you've got the goods and makers, Gap, Marvell, Ulta Beauty, Alibaba. Let's get right to the floor show. Joining me now, Great Hill Capital Chairman Tom Hayes. And Tom, one of those names on that earning calendar is the one you say to buy. Before we get to that, give me your sense right now of how the markets look. A little bit of a pullback after the big Friday rally. What does that tell you?
Well, look, we've been pound the table bullish for months now. Markets moved a long way, 30%, but we remain constructive. We've got Powell, 86% chance of a cut in September, 82% of 2 cuts by December. We got earnings have been blowout earnings. We were expecting 4.8% earnings growth. We got 11.8%. And most importantly, Liz, earnings estimates are going up for next year. Went from $300 a share to $303 a share, which brings the multiple down a little bit. So a lot of reasons to be excited. And believe it or not, if you look at institutional positioning, it's elevated in equities, but it's not yet extreme. So there was a lot of skepticism for this most hated rally V-bottom.
You know, if you take away the headlines and the worrisome questions that have the markets, as we said at the top of the show, switching back to the caution setting, if you take those away, like tariffs and the wars, et cetera, that are all over the world, and you just look at earnings, you've got 95% of the S&P having reported. 80% of those that have reported have beaten earnings per share. And then you look, 79% have come in better than expected on revenues.
Yeah.
So that tells you a lot, does it not? That these are companies that are making money, they are doing well, and they're beating estimates.
Yeah, and with the market being a discounting mechanism, looking out to 2026, 13.6% estimated earnings growth, close to 7% revenue growth. So things are firing on all cylinders, and then you're going to have the afterburner, Powell, just-in-time Powell, maybe not too late Powell, maybe just-in-time Powell, lowering rates, which is going to help what? It's going to help small caps. It's going to help the unmagnificent 493 that have kind of lagged. So when we say we're constructive, Liz, we got to be selective where we're constructive after such a big move.
Okay, back to that earnings calendar and how selective you are. There is one name on there that you say pile in on.
Look, the bane of my existence, we brought our basis down over the years to $82. Yeah, it's doubled off the bottom. So people are like, did I miss it? You haven't missed it. It's just getting started with Alibaba, okay? Alibaba is kind of the Amazon of China. Chinese stocks, the Hang Seng Index has outperformed the S&P by 3 to 1 this year, 30% year to date versus 10%. Alibaba is kind of the key component. They've got, number one, it's a toll taker on the middle class, okay? So they've got the largest retail business in Taobao and Tmall. They've got 40% of the cloud business. Think Amazon Web Service, they're growing like a weed. 18% per year. You know what's growing the fastest? The AI component.
The chatbot that they've come out with, exactly.
It's unbelievable. Number one, it's faster on many metrics. Number two, that business is growing triple digits every quarter for the last 7 consecutive quarters, and their international commerce business is growing at about 30%.
So what is your answer when we see that the Dow finally caught up, had its first record on Friday of 2025? Finally, the S&P has been firing on all cylinders, same with the NASDAQ over the past several weeks.
Yeah.
What's your answer when people ask, listen, trees don't grow to the sky. Where's that 10 to 15% correction that we might see?
Yeah, this is the catch-up trade. Managers have to catch up. A lot of them were skeptical. The laggards are going to outperform. I think if you chase the indices, you're going to be disappointed. But here's some data for you. Over the last 100 years, we get a 20% correction every 3.5 years. We've had 3 of those in the last 5 years. So we're kind of stuck with recency bias. Everyone thinks what just happened, the big correction in April, is going to happen again. They're going to be disappointed. You want to buy these small dips, 3 to 5% pullbacks into year end. We're going to resolve higher. Earnings are there, growth is there, Fed policy is there, and positioning is still a little bit offsides.
Well, fraidy cats who got nervous, and look, there's nothing wrong, by the way, with taking some profits off the table.
Yeah,
nothing wrong
correct.
with that. But people who've been anxious and said, well, you know, we're now in 2 years of people coming in and saying it can't go much higher, and they've missed out on the rally. Good to see that you have not, Tom.
Thank you very much, Liz. I appreciate it.
Good to see you.
Yeah, likewise.